Very much welcome to the Swedish House of Finance. My name is Per Wisén, and I will be moderating the seminar this morning. The Swedish House of Finance is a national financial center. That means that we do PhD courses for universities all over Sweden. We have databases that anybody can use. We teach, we do research, and we do outreach. Outreach are seminars where we present financial research that can be useful for you in your daily work, and this event is an example of outreach. And we share the premises here with the Department of Finance at the Stockholm School of Economics. So we are like 65 or 70 people all in all from countries all over the world sitting around here. It's a very exciting place to be. And today we are very honored and happy to have Tobias Moskowitz with us as our guest, and he will be introducing the topic Investing with Style. Tobias Moskowitz research, I have to read this, is on studies of financial markets and investments, including the behavior of prices and investors. He has explored topics such as momentum in stock returns, biases in investment portfolios, the social effects of bank mergers, and a lot more, and also written a book on the explaining the hidden side of sports. So Toby is a person with deep knowledge on very varied subjects. So very much welcome, and we will do like this. Toby starts, and we do it the academic way, which means that you don't have to sit and listen for 30 minutes and then try to remember what questions you had. So that when a question or comment pops up, raise your hand, make sure you get a microphone and take it immediately. That's how academics do it. You never know how seminars end up in academia. They can sort of go anyway, which is interesting and nice. And after Toby, Kerstin Hessius, who probably doesn't need much of an introduction. Kerstin has had every important work in the Swedish financial sector that I can think of. She's been deputy governor of the central bank. She's been head of the stock exchange. She's been CEO of a dealing firm. She's now CEO of an AP fund. And we are very happy and proud to have you here to comment on what Toby's been saying, and I think and hope tell us a little bit about how you are doing it. So once again, very much welcome. Tobias Moskowitz, please, the floor is yours.
Is that on? Okay, great. Thank you, everybody, for being here this morning. Thank you for the introduction, Per. As Per mentioned, I actually do some research in sports as well, but I won't be talking about any of that today. This is something that it's a topic I've been working on for pretty much since my dissertation in the late 90s at UCLA, and certainly in the last 10 years I've been focusing quite a bit on. I'm going to call these style premia, but you may have heard of them as factor risk premia or alternative risk premia. People call them smart beta. These are all marketing terms. An academic like me would give it a boring title like systematic sources of returns. Style is a little bit of a marketing ploy as well, because as you'll notice from my background, I'm a professor at Yale, but I'm also a principal at AQR Capital Management. It's a firm I've been consulting with for about 11 years now. They take academic research and apply it in practice. So I know a little bit about, not as much as everybody here, about applying this stuff in practice, but this is sort of a culmination of my academic work combined with some of the things I do for AQR. So let me explain further. So what I'm going to do in this is actually a culmination of a couple of papers. I'm going to talk about a century of evidence on these factor risk premia, and this is actually based off of an academic paper I'm currently writing. It is not fully written yet, so unfortunately my discussant only got the slides, so I'm sorry for the lack of information there. But we actually have a set of returns going back more than a century, not just in stocks. US stocks go back to about the 1920s, but commodities going to the late 1800s, currencies, fixed income markets. Currencies are a little less interesting because there was a fixed exchange rate for many, many years in the early part of the century. But what we're going to do is do a broad out-of-sample test of a lot of the things that have been talked about in academia, and then see if we can learn something from that. And so that's the idea, okay? And let me tell you what we're talking about here. I'm going to focus on what I would call the 4 main style factors or systematic risk premia that are out there. There's going to be a couple that are noticeably absent that I won't talk about. But let me first start with value, momentum, carry, and defensive. I'm guessing all of you know what these are, but very quickly at its most basic level, value is simply the tendency that cheap assets tend to outperform expensive assets. And by the way, we're making no contention that these are cheap because they're risky or cheap because they're mispriced. So I'm being agnostic as to whether this is priced correctly in a rational market efficient world or incorrectly in a behavioral world. We just know these things empirically tend to work, that there's a positive expected return for cheap assets over expensive assets. Momentum is the tendency for an asset's recent relative performance to continue in the near future, something I started working on back in the late 90s for my dissertation. Carry, the tendency for higher yielding assets to provide higher returns than lower yielding assets. This has predominantly been focused on currency markets, but as I'll show you, you can apply this concept in any market, fixed income, commodities as well. And then defensive, this has lots of names, but you can think of this as low volatility, low risk. Low risk assets or higher quality assets tend to outperform high risk assets on a risk adjusted basis, okay? And that's the key. Now, what's missing from this list, something I won't talk about, which I do think is important, is a liquidity risk premium. That's ignored here for the purposes of our analysis, in part because everybody disagrees on how you measure it. We all agree it's there, and none of us know how to measure it. At least that's true in academia. But I'd be curious to hear what your thoughts are on that. But that's not on this list. Okay. Now, where do all these things come from? Here's a very biased timeline of research. Biased because you'll see a lot of my name up here, but there's plenty of others. But you can see, going back to some of the giants in the field, many of whom have won the Nobel Prize. You've got Bill Sharp's early work on the capital asset pricing model. You could think of the first style as just market exposure, or beta, as being a characteristic we care about for returns, as well as the famous work of Fama and French, Ken Rogoff's work on the currency carry strategy, and then all the way through time. Now, yes, I put a bunch of my own name up here, but for every one of my papers, there are dozens of others in academia. We keep writing about this today. This is, I'm a member of the National Bureau of Economic Research in the United States, and at our conferences, which are 3 times a year, the dominant topic in asset pricing is, what do these factors mean? How do we understand them? Do we believe in them? That's really what we still continue to talk about. What drives returns? Okay? So, given all that research, what else could we possibly learn about these factors? Right? We've sort of trudged the data to death and looked at these things for many, many decades. Well, here are some of the things that we're debating at all these conferences and in all these papers. And I'm hoping that this paper, this research, can at least start to begin to answer, or maybe shed some light on some of these questions. So there are many questions that still remain, okay? Some are more informed than others, but this question always comes up, right? Are these styles just data mined or overfitted to a specific sample? This actually had a resurgence in academia in the last couple of years, where people have claimed, look, the standard t-statistic that we use to judge significance of these tests is way too low. The fact of the matter is, thousands of us look at the same data sets, we all focus on the results that are significant, and we don't properly adjust for that, collective data mining. I don't believe that these things are data mined, but I'm going to have some evidence, further out of sample evidence to kind of show you that, okay? Now, there's a bigger question, which I'm not going to be able to answer, but maybe I can shed a tiny bit of light on, is if these things do exist, are they behavioral or risk-based? That is, are they rationally priced in compensation for risk, or are they mispriced due to some behavioral phenomenon? I'm certainly not going to be able to answer that. If I could, I'd be back here in December. That would be a home run if you could do that. But I may be able to shed just a tiny bit of light on this, or at least provide some other tests that might signify one way or the other. A big question that comes up, and always, this is something when I put my non-academic hat on at AQR Capital. So not surprisingly, my work with AQR, we sell these things, right? We package value, momentum, carry, and defensive in products and sell them as exposure to these style factors. And this question comes up all the time. Under what macroeconomic conditions do you see one set of factors work versus another? How do we, what environments are these things sensitive to? Well, the problem with that question is often we're dealing with 20 or 30 years of data where we don't have a lot of business cycles. We don't have a lot of macroeconomic shocks, not a lot of data to look at. With a century's worth of data, perhaps I can provide some clearer answers on this. As you'll see, I won't be able to, but I'm going to try anyway, okay? And then related to that, if we understand what the macroeconomic environments are, the natural question, which is why our clients ask this, is, can you do something about it, right? If you know when value is going to succeed or fail, can you time it, okay? And so that's a natural question that comes up as well. Again, with a century's worth of data, I might have some hope of answering that question. With 20 or 30 years, I have no hope at all, okay? And then finally, what about the alpha of these strategies? So kind of related to the first question, has there been any decay in these things over time? Not so much because of data mining, but because more firms like AQR invest in these things, does that drive down the profits or the risk premia associated with these? And again, a much easier question to answer with a lot of data. Okay, so many of these questions simply aren't answerable without a very long sample of data. And I'm going to argue, even though I have a lot of data, it's still not going to be long enough in some cases, okay? So what would we expect if we try to answer these questions? Well, the first one is, if the styles are data mined or overfitted, what should we expect? We should expect to see poor performance out of sample. Now, what's nice about the data set I have is I can look at out of sample in two ways. I can look at out of sample subsequent to the initial publication of these in the academic literature. I can also look at a sample that no one studied before, which is prior to the initial discovery of these things, because I'm going to have data that goes much further back than anybody's been able to look. That's sort of interesting, okay? And on the one hand, it's interesting because it's another out of sample period. On another is no one knew about it before its discovery, so you couldn't argue it was traded away, right? The problem is if I see it disappear out of sample going forward, I don't know if it was just statistically data mined or if people drove it away, right? What about behavioral versus risk-based? As I said, I'm not going to be able to answer this question fully, but I can provide some insight on some of these questions. For instance, you might expect that if it's risk-based, the properties would behave in certain ways. For instance, during crashes or during extreme market environments, you might expect different performance from these strategies. Whereas if it's behavioral, you might expect that these profits, these returns have diminished as more and more people exploited them, and that their correlations have changed. And I can look at a number of those things. And then, as I mentioned, with 100 years of data, I might have a hope of measuring some macro exposure or some ability to time these, as well as measuring some changes over time. Okay, so let me get into the century of data. What are we talking about here? So the data, and by the way, one of the reasons I like to work with AQR is they get access to this data or construct it themselves and then let me write whatever I want about these things. And so here's an example. We put together a data set of 43 equity markets, 10 government bond markets from 10-year government bonds from 26 countries. U.S. stock, so these are equity indices. Just to be clear, we have 43 equity index markets going back a century, okay? So not just the usual stuff, MSCI, going back about 30 years or 40 years, but this goes back to the early part of the century in the 1900s. We have, for 26 countries, 10-year government bonds going back a century. We have U.S. stocks. This comes from CRSP, the Center for Research and Security Prices. That goes back to 1926. We have international as well in about 26 markets as well, but it only goes back to the 1970s. So we don't even have that in here. It's too short. And then we've got commodities prices for 40 commodities going back to the late 1800s. And then currencies, these actually go back pretty far, but they're not very interesting prior to 1970. Okay, because with fixed exchange rates in these developed markets, they don't move. Okay, so although One of my co-authors on this paper recently told me, Antti Ilmanen, some of you may know him, there's some data from when Keynes was doing his work with currencies back, I think in the mid to teens, 1900s and 20s. We're actually thinking of adding that, but then there'll be a 40-year gap where nothing interesting is going on. So we haven't done that yet. Okay, so those are the markets we're going to look at. Now, how do you measure value, momentum, carry, and defensive in each of these markets? Let me start with the easiest one first, momentum. Momentum's simple. We can apply the exact same definition in every market. The past 12-month price return, excluding the most recent month. That's a standard academic definition. We can apply it to equities, bonds, individual stocks, commodities, and currencies ubiquitously across all those markets. No issue there, okay? For value, for equities, it's pretty straightforward. We're going to use something like, book to price, or some measure of earnings to price, some measure of fundamental value to market value. So for market indices, we're just going to use CAPE because, it doesn't matter whether we use CAPE or some aggregate measure of book to price. This one people tend to like better because it adjusts for earnings and inflation and a number of other things, but I can tell you it doesn't matter for the results. For individual stocks, looking at book to price, and then how do you define value for bonds, for instance? What's the notion of a fundamental value to some market value? Well, remember what value is. It's about identifying something that looks cheap versus something that looks expensive. So a natural measure for bonds would be, a fundamental value would be, take the cash flows of the bond and discount it at expected inflation rates. Okay? You can get expected inflation rates from analyst consensus or from a model. And so what we do here is simply, one way to measure whether a bond is cheap or expensive is look at the real bond yield. The yield on the bond minus expected inflation. And the expected inflation number we use is the consensus estimate from analysts for 10-year government bonds when we have that data, which goes back to about the late 1980s. Prior to that, we try to estimate that from a model that we base off of the consensus data. What about for currencies? What's a measure of value? A measure of value for currencies, again, appealing to economics, is purchasing power parity, right? The idea is if you buy a cup of coffee in Westport, Connecticut, where I live, and you buy a cup of coffee in Geneva, Switzerland, they ought to have the same price, right? Now, of course, if you've been to both those places, you know they're vastly different. So what does that mean? It means one currency looks quite expensive, one looks cheap relative to the other, but in the long run, you'd expect them to converge, okay? And then for commodities, to be honest, we don't have a good measure for value. I'll just tell you that right now. So as a very simple measure, we appealed to Dick Thaler's work with the Bont, where 5-year reversal in returns seems to be what we often call a poor man's measure of value. So absent any measure of fundamental value, pick 5-year reversal. Okay? Now I can tell you you can use more sophisticated measures here, but the goal of this paper is to use something very simple, universally accepted, and kind of see what the results look like. Now, what about carry and defensive? Carry is very simple. The way I think about carry is, think about it from currencies. What's the return you get if market conditions stay the same? So in currencies, if the spot exchange rate doesn't move, the return you get is the differential in local interest rates. Okay? Buy and hold, that's the return you get. So similar concept in equities. If I buy the stock index and nothing happens, that is the index price doesn't change, I expect to earn the dividend yield, okay? In global bonds, it would be the term premium, and in commodities, it would be the futures curve roll down. Now, we don't define it for individual equities because the dividend yield is pretty much the same thing as book to price. It's like double counting value, but I guess I could have put it in there for completeness. And then finally, defensive. People often define this in many different ways: low volatility, low beta, high quality, like accounting measures. We're just going to apply something as simple as we can. We're just going to use beta here, but you could obviously add a lot more measures. But again, something simple, a single definition, and that's it. The only place we don't define it is for currencies, because I don't really know what a beta is. I don't know for currencies. They're all bilateral exchange rates, so there's no natural benchmark there. Okay, so with all that, let's take a look at what we're going to do. All right, so what I'm going to do here, the first test that we're going to run is I'm going to look at the original sample of data. Sorry, I have a full century of data here on each of these asset classes. And what I'm going to do, and this is just an illustration, is go back and look at the papers that were written about each of these styles, mostly in US equities, to be honest, but some in other markets like currencies for the carry strategy, and identify the original sample period over which those studies were discovered. And then what I'm going to do is separate the sample into the original period over which it was discovered, what happened after it was discovered, as well as look at what happened before it was discovered. And this is relatively new. Okay, people haven't had this data. All right, so let's take a look at the results. First of all, here's what value, that is, so let me be clear, these are long-short strategies in every asset class, cross-sectional strategies. So I'm long the cheapest currencies, short the most expensive currencies based on purchasing power parity deviations, fixed income, equity indices, US stocks, commodities, and multi-asset is an average of all these things in a multi-asset portfolio, okay? So you can see here that there's a strong and healthy value premium. These are Sharpe ratios, annualized, in every single asset class. And this is something I've been basing, the last 10 years of my career on, which is to say that the original work of Fama and French and others focused on US stocks and the value effect. But we see a healthy value effect in almost every asset class. It's not unique to stocks. In fact, our theories that explain this shouldn't be just about stocks. They should be more broad. The same is true for momentum. Momentum, which I focused on in my dissertation, is all about US stocks, but you see it very much in commodities, equity index futures, fixed income, and currencies, okay? And again, notice that there's diversification across these asset classes. The whole is greater than the sum of its parts, okay? That a multi-asset portfolio has a better Sharpe ratio than any individual portfolio. Same with carry. Carry was initially discovered in currencies, and the entire literature focuses on the currency carry strategy. But a carry strategy in fixed income is even better, in fact, and it's good in equities, it's good in commodities as well. It has this uniform premium across all these markets. And then finally, defensive. And again, there's no defensive in currencies, but defensive strategies, buying low risk, low beta assets and shorting high risk, high beta assets works pretty well in other markets as well. Initially discovered in US stocks, but works in other markets as well. Now, I'm not going to show you the formal statistics here, but if you run a statistical test as to whether these Sharpe ratios are different across all asset classes, you can't reject that they're all the same. In other words, for all intents and purposes, statistically, even though these bars look like they're at slightly different heights, you can't reject that these are all the same numbers, which is really interesting. What it says is the value and momentum premium in individual stocks is about the same. It's the same compensation you get from applying the same concept in fixed income, in commodities, and in currencies. Now, I'm saying that, of course, this is all gross of transactions costs, right? That's a whole nother issue. And we may get into that in the Q&A perhaps and afterwards. But you can also see why I end up working for AQR, right? What AQR does, and not just us, but other people like us, is they take this concept, package it in a multi-asset framework, and then figure out how to trade it. That's where it becomes above my pay grade. I stop here, and then they take it from there, okay? And that's the idea. And you can see the power of doing that, right? The multi-asset framework, much more stable, which I'll show you in a second. Okay, so that's over the entire century, all right? What's interesting now is to compare those sample periods that I mentioned, okay? So let's consider the full 100-year period. This is what these things look like, and that's one last thing. This is multi-asset across all of these. What we do at AQR and what we to maximize the Sharpe ratio is not just diversify across asset classes, which most people have figured out, but diversify across the factors themselves. And this is where it gets really interesting. The multi-style has a much bigger Sharpe ratio, and that's because the correlations among these factors are relatively low, and in fact, when it comes to value and momentum, they're negative. So you combine those things, it becomes a very powerful tool. Okay. Now let me compare, this is the original sample, purposely dimmed, okay? I'm going to superimpose this, what those Sharpe ratios look like if I look at the pre-sample, okay? That is the period before these were discovered, all right? And what do you notice here? Well, what you notice is there's kind of good and bad. On the positive side, when I look at an entire sample that nobody's looked at in many of these asset classes, I find positive return premia for all these styles, almost everywhere, but pretty much everywhere, okay? That's good news. It says out of sample, this stuff holds up. What's the bad news? It's not quite as strong as the original sample, right? Meaning that there probably is a little bit of overfitting in the original research that academics have done. That's natural. It's not so much overfitting that these become random out of sample or zero, but you notice in almost every case, there's a little bit of a degradation there, okay? So that's looking at pre-sample versus original sample. Original sample, not the full sample, but the original sample that each paper discovered these things in, all right? I can do the same exercise, there's the original sample again, and put on top of that the post-sample, the period after the discovery, after these papers were written. And again, you see something similar, which is after these things were published, the risk premia are generally positive. That's the good news. The slight bad news is they're not quite as positive as the original sample suggested, okay? Now, what's interesting is to compare those two, okay? Here's value. Pre-sample, pre-discovery. So now what I'm going to do is remove the original sample period from the 100 years and look prior to discovery versus after discovery. And what do you notice? Well, you notice that actually the Sharpe ratios, at least for value, are, if anything, a little bit stronger after discovery than they were before discovery. So this notion that once these things were discovered, people competed and priced them away doesn't seem to be what's going on. Okay, at least not yet. Now, you could argue maybe not enough dollars have chased these things. My AQR buddies would be very happy if that were the case, okay? But certainly you don't see any evidence of that. Now, is that true for the other styles? For momentum, it also seems to be true, okay? I mean, it's certainly no weaker in the post period than it is in the pre-period. So yes, there might be a little bit of overfitting. The original sample period looks better than the 2 out of sample periods, but the 2 out of sample periods don't look any different. Same with carry and same with defensive, okay? So what this says is this notion that maybe these things were behavioral and that arbitrage was going to compete them away, we don't see any evidence of that. It's not like these things are half the size as they were before their discovery. It's not like they've diminished. If anything, they look just as strong, if not stronger, okay? All right. And the other thing is that's interesting about this, that's the multi-style approach, is that it's also the case that looking at the pre-period, these return premia have been a part of markets well before we studied them. Well before we studied them as a science, before we even knew what these factors were, we see that they were pervasive in markets. So it's not like it's a self-fulfilling prophecy either. All right. I'll skip over this in the interest of time, but we actually did this decade by decade, if you really want to break it down. And it's really interesting. Of course, you can find a decade or two where a single factor doesn't do well, or you see some underperformance. But in general, the performance across all these factors in all these different asset classes is remarkably stable. Okay? In fact, multi-style, you don't find a bad decade in any asset class, and multi-style across all assets, very rare to find anything that suffers. Maybe, right around for value, right around the Great Depression, but the blue bars here, the multi-asset, multi-style, is very, very steady. Okay? All right. Now, what about the correlation structure? So the first set of results is the performance of these factors works pretty well out of sample, not as well as the original sample, but still fairly robust. The other thing we could look at is the correlations. Okay? The correlations are interesting because, as I said, there's tremendous diversification across these different factors. Namely, as I've highlighted here in red, value and momentum. This is a well-known result. These are US stocks. Value and momentum have about a negative 0.5 correlation. Okay? Now, is that true in other asset classes? It's remarkably consistent. Okay? It's not always negative 0.5, but it's always strong and negative. Whether we're talking equity indices, fixed income, currencies, commodities, or all asset classes, value and momentum move in opposite directions. That's nice. If it were just random, if it were just data mined to US stocks, you would not expect that. The fact of the matter is these two things behave as a system almost. They exhibit similar properties. And even though we're measuring them slightly differently in different asset classes, they maintain the same characteristics, which is sort of nice. What about some of the other ones? Well, carry, defensive, basically have correlations pretty close to zero in equities. That's also true pretty much in equity index futures, some positives here, fixed income, currencies. You do see some differences. For instance, in commodities, value and carry are a big negative, but in fixed income, value and carry are a positive. And similarly, momentum and carry in commodities is a positive, whereas momentum and carry are pretty much closer to zero in the other asset classes, right? But so the main one being value and momentum, but these correlations also give you tremendous diversification benefits. Now, another question we can ask, of course, is have these correlations changed over time? Do they move around, let's say, during certain times? Have they changed at all over time? So you can imagine, for instance, that if we look out of sample, if you're worried that people trading on this stuff, firms like AQR, trading on all these things simultaneously, that would increase the correlations of these strategies, right? So we can see if that's the case looking out of sample as well, okay? So let's take a look at that. Here what I'm plotting is the average correlation across all the asset classes between value and momentum, for instance, okay? And I'm going to report it in 3 sample periods: prior to its discovery, during the original sample, and after its discovery. And you see something sort of interesting here, although I don't want to make too much about small movements, but there is a little bit of a pattern, which is prior to discovery, the correlation is negative, negative 0.44. It increases in the original sample and increases a bit further out of sample. So one thing you might, you sort of squint at this. Look, it's not going from 0 to negative 0.5. It's sort of, negative 0.4 to negative 0.59. It's not a huge difference, but it is a consistent pattern with what most people think, which is as we've discovered these things and traded more on them, perhaps we're exerting a little more correlation on these strategies, particularly value and momentum, which move in opposite directions. Maybe there's a little bit of additional correlation we're injecting there from trading. That's a conjecture. I don't have any concrete proof of that. What I think is also interesting is look what happens to value and carry. Basically, in the original sample, they had 0 correlation. In the prior period, close to 0, but now they're quite strongly negatively correlated, okay? And I'm not sure I have a good explanation for that other than it's interesting. Value and defensive haven't changed a whole lot, but momentum and carry have also increased somewhat over time. Momentum defensive as well, and carry defensive pretty much flat. So if I look at this, it does look as if the correlations are a bit more extreme in the more recent period than they were in the original sample period, and certainly prior to the original sample period. That's somewhat interesting, okay, and something that we're going to continue to explore. You can also look at this slightly differently. This is looking at the same factor across asset classes. So we know that there's a value premium in currencies, commodities, equities, and fixed income. Have the correlations across those asset classes become stronger over time? Okay? In other words, if there are more firms like AQR that use value in not just equities, but across all these asset classes, does that induce some stronger correlations? And this you can see, it's pretty much true for every single asset class. Every single factor. For value, the average correlation in value strategies across asset classes has gone up over time. Now it's still small, right? So part of me sort of as a statistician says, you're squinting at this and saying something that's almost 0 looks a little bit higher than something that was basically almost 0 as well. These might all be 0, but it is interesting that in every single factor, the correlations go up a little bit, okay? Let's wait another 50 years and see if that continues. That doesn't help any of us here today, but at least this trend is somewhat consistent with the anecdotal stories that people are suggesting that as more people have been trading on this and discovered them, the correlations have risen. Okay, but nevertheless, this is a far cry from a correlation of 1, right? Let's be honest. These are still these are still small correlations. Okay. So those correlations have changed a little bit through time, but not a lot. You can also look at these correlations relative to the market itself and relative to the fixed income market. This is what they look like. These are long-short strategies. For all intents and purposes, they hover around 0. There are times when they're negatively correlated with either equities or fixed income, but in general, at least I look at this, I don't see too many trends. In fact, we just updated this graph. When I used to present this, the graph ended right here, and everybody was making a big deal about that upward trend with equities from that purple line. And I thought, well, that's interesting. And then, of course, it's flattened out since. We'll see where it goes from here. But it's hard to tell a story that the correlations have changed dramatically with traditional markets over time. It looks pretty flat. Okay, so we're pretty sure these things aren't data mined, okay? I think we can cross that one off the list. In other words, there's a little bit of overfitting the original sample, but the fact that these things look very robust in 2 out of sample periods and across different asset classes, and the correlations don't look dramatically different, they've increased a little bit, but they're still roughly the same, suggests that this thing doesn't look like it's just dumb luck, right? It doesn't look like it's data mined, okay? But what about all the other questions? Did we learn anything about behavioral versus risk-based stories? Maybe a little bit. For instance, the behavioral stories would say that the risk premium on these things would reduce a lot after they were discovered. As more and more people arbitrage them, we don't see a lot of evidence of that. We see a tiny bit of evidence that correlations increased a little bit, but not a lot in terms of the returns, okay? So if this is the case, maybe, but not enough has been done yet to even make a dent in these in the profitability of these strategies. What about macroeconomic conditions and timing? Well, let's look at that next, okay, as well as whether the alpha's decayed over time. And this will be sort of the last thing I do. So let's dive a little deeper and explore some of these other questions. First of all, how do the styles behave during a crisis? That's kind of a natural question we always get asked. Well, what happens when the world blows up in 2008, for instance, or whenever the next one happens? Here's what you see. I'm plotting here the return to a multi-style, multi-asset, risk premia portfolio that's long-short against, this is US equity returns, but if you do global equities, you get the same picture. And what you find is it's pretty much a cloud. That is, it's flat. The performance of the styles themselves is fairly immune to these extreme market returns, right? If I look at big positive US equity returns, the performance on these styles is no different than big negative ones, okay? It's pretty flat, and that's actually a nice feature. It's relatively uncorrelated to traditional markets, just like that correlation picture I showed you, all right? But let's also take a look at some macroeconomic environments, okay? So for instance, I'm gonna define the following 6 macroeconomic environments. I'm gonna look at a growing economy, up and down, okay, down growth, up growth, a low inflation and a high inflation environment, and a low volatility and a high volatility environment. Now we know what equities, this is for global equities, we know what equities do. Equities like high growth and don't like low growth, okay? Inflation, equities are relatively immune. Here it's a little bit positive in low inflation and slightly lower in high inflation environments. And equities like low volatility and dislike high volatility environments. We also know what fixed income is going to do, right? Fixed income is the opposite. It likes low growth versus high growth. It likes low inflation versus high inflation. And it likes high volatility versus low volatility. This is that flight to quality everybody talks about. What about the factors that we've been talking about, these styles? Well, they aren't affected by the same macroeconomic environments. Whether you're in a high growth or a low growth environment, they give you about the same Sharpe ratio. Same with high and low inflation, and pretty much the same with high and low volatility. And this is something that I think a lot of investors get, when we talk about this stuff to our clients, a lot of investors, they want stories like this. Well, how does value do in a growing economy versus or a deflationary economy? And our answer is always it's relatively immune to those things. That our traditional markets we've thought about for many, many years, we sort of understand the macroeconomic environments where they do well and don't. For these styles, we don't really understand that yet. So the next thing we tried to do was try to understand what macroeconomic environments these things respond to. And I can tell you, I'm not even going to show you the results because there's just nothing there. We did for a century, I defined tail risk events, high and low volatility, growth regimes, not just using up and down growth, but business cycle expansions and contractions, not just in the US, but globally in each country. We looked at inflation in many different ways. At a whole bunch, we basically tried to data mine the hell out of this to find anything we could that related to these styles, and we just found no consistent patterns, okay? And so, even though we had 100 years of data, we still didn't find a lot of macroeconomic sensitivity to these different environments. And by the way, I should mention that because there are a number of papers that suggest that value and defensive strategies work better in certain environments and others. And those are true in their sample periods, which are typically about 20 years of data. We find none of that is true when we look at 100 years of data. It just doesn't work particularly well out of sample. Okay. Finally, has the alpha decayed over time? Well, these are plots of the alphas of the styles in equities, fixed income, currencies, commodities, which is very volatile, and US stocks, as well as multi-style. Okay, actually, let me just stop here. You can see that the alphas will go up and down across all these different markets, no doubt. But I don't see a trend here. It's not, again, it comes back to the same point. I don't see much alpha decay. And if I look across all the styles and put it all together in one portfolio, maybe we're seeing a little bit of a decay here, but it's not jumping out at you. All right. Finally, last thing is, can I time these things? Okay. So let me just explain what I mean by timing the strategies, right? This comes back to, do I know when value or momentum is going to work, and can I shift weight from one to the other to try to time the styles? This always comes up because one of the things that an academic, someone like me would say is, what I would suggest is you buy value, momentum, carry, defensive strategically, and do no tactical asset allocation whatsoever. By the way, I believe in that generally. I know that's going to, very few people want to believe in that. And every day, I would say at least once a month at AQR, we have a research project that says, let's revisit that. There's got to be a way to time this stuff. Haven't come up with it yet, okay? And we employ, I think it's 65 PhDs working on this full time. Still can't figure out how to do it. And so my answer is, it's not that it can't be done, it's not worth doing, okay? And the reason I say that is, let's start with the macro stuff. I couldn't even find, with 100 years of data, any regimes where I could tell where value or momentum or carry or defensive was going to do better or worse, right? So that's in a contemporaneous way. Now you're asking me to try to predict those patterns, okay? That is really, really tough. And by the way, if I could predict recessions and expansions, I've got a much better strategy for you, right? Let's just trade stocks and bonds. That would do very well. But I have a hard time doing that. Nevertheless, I'm not giving up on this timing stuff, right? Because macroeconomics is not the only way to time strategies. So I had no luck doing that, all right? Why don't I try some other things? People talk about value spreads, for instance, right? When the book-to-price ratios of stocks is very wide, maybe that's a good time to get into a value strategy. When it's very narrow, maybe you get out of it. Well, that concept could be applied not just to value or for each of these strategies, but you could apply the same thing in terms of spreads in all of these. Momentum, carry. In other words, when the carry spread is wide, is that a good time to be in carry strategies? When the momentum spread is wide versus narrow, is that a good time? Another way to time these strategies is to use momentum itself. We use momentum as a concept to build these factors, but you could think about momentum in the factor itself, something we call factor momentum. So think of it as the momentum of the momentum strategy or the momentum of the carry strategy. So if the carry strategy is done very well recently, is that a good or a bad time to get in and out of the carry strategy? So we look at all those concepts as well. So here's what we do. We're going to cheat. What we're going to do is run a full 100-year regression on timing these strategies using macro variables, using value timing, using momentum timing, and we'll even use volatility timing, another thing that people have looked at in academia. We're going to fit the sample over the 100 years as best we can, and whatever the numbers come out to, we're going to use that to reconstruct a timing strategy to try to outperform a simple buy and hold strategy. Okay, so that's not, and if you were actually doing this in practice, you wouldn't have the luxury of looking at 100 years. You'd have to look at each point in time using whatever history you had. So in some sense, this is cheating, and yet we still don't get anywhere. So here's an example. Suppose I'm looking at currencies. If I use a multi-style portfolio and I buy and hold versus this mega timing model that I've built in sample, I actually do a little worse. And why do you do a little worse? How could you possibly do worse? Any ideas? Well, these are Sharpe ratios. And this is what I mean by it's not worth timing these things. A lot of people think timing is innocuous, right? If I do it and it adds nothing, I don't lose anything. That's not true. You lose something very important, which is diversification, right? By timing, I'm implicitly shifting weight to one style or one asset class at the expense of another, meaning I lose diversification benefits when I do that. So if I gain no returns, I actually increase my volatility, my Sharpe ratio goes down a little bit. So this turns out to be approximately true in almost every case, not quite, okay? But pretty much in every case, the full sample timing strategy does slightly worse and certainly no better than a simple buy and hold strategy, okay? And by the way, I'll say this till I'm blue in the face and still no investor will believe me. There's got to be a way to time this stuff. I just haven't figured it out. Okay. So did we learn anything new here? Well, we think so. There's always going to be naysayers, but with a century of evidence, we don't think these things are data mined. Okay? We might have learned a small amount about risk versus behavioral stories, looking at the correlation changes over time and the lack of a reduction in alpha. And we didn't really gain any new insight on macroeconomic conditions or any other insight on timing. Now, I view that as a strong negative result, which is harder to publish, admittedly. But I would let, to me, this is interesting. It sort of says, even with another 100 years of data that nobody's looked at, we still find the timing results very underwhelming. That makes me feel even stronger about how difficult it is to time these things. But as I said, it's harder to publish a negative result. Okay, and have these decayed over time? Not much. So let me stop there. I was going to talk a little bit about implementation, but I'd rather hear from our discussant, and we can talk about this in the Q&A, and I can talk a bit more about that. So let me stop there. Thank you very much. Oops.
So, thank you, Toby. It was interesting, and of course, it's also interesting to have this very long-term view on things. We have been active in the market since 2001, so we don't have that long-term perspective, and we have not been active in this area for more than about 5 years. But however, short presentation, what AP3 is. AP3 is one of the Swedish buffer funds in the Swedish pay-as-you-go public pension system that's mandatory. And we manage about 345 billion Swedish crowns. It corresponds about 42 billion US dollars. And it's a diversified portfolio. Basically, we can say, our return target is 4% real, and we have had about 4.6% since inception. We think harvesting risk premia is our core business. But of course, more of it is like beta risk premiums. And we have, you can say, since 2008, it has been quite easy to harvest risk premiums like liquidity premium, like equity premium, and small cap premium. But we are so dependent on equity risk premium that we really try to diversify the portfolio in various ways. And we started to develop new premiums in 2008, 2009, and with the insurance risk premium, like catastrophe bond portfolio that we developed, and still is going there, or we still have it, and it has given us some good returns, and also with low correlation with the equity market. In 2010, we started to investigate volatility risk premia in equities, and we started to implement strategies also a little bit later, and it has been successful. Not because it's not so correlated to equity risk premium. It's really correlated, actually. However, or in some periods, not so good. But if you build the strategies in a certain way, it can be quite good. But I think timing is important there. However, with this encouraged developments, or encouragement in the performance in our development, we started to look into the risk premium as you discussed in 2013, and we decided to give mandates to external managers and that they have multi-strategies. But our experience during these years that we started this up was that they over-diversified. So we were not so satisfied. So we actually brought the strategy in-house and started to develop our own portfolio structure. And that was done last year. And now we try to develop this strategy successfully. And I'm not the expert. I actually have the expert with me. That's Fredrik Giertz. That is my portfolio manager, and also or a construction manager. And I think he will give you more of these practical experiences we have than I can give you. So this was just a short introduction of Fredrik that is working with this. So I think you better give some comments on what you think about what Toby has presented.
Thank you. I mean, this isn't on, but I guess you will hear me anyway.
Isn't on? Yeah, they need
it. Says on. Ah, okay.
Is it on now? Yeah.
So as Kerstin said, risk premium is a core DNA of our portfolio. It can be done in several different ways, and it's obviously all about diversification. But diversification has to be understood in some way. You can do diversification from a pure correlation perspective, but you can also do it from the approach. We have the kind of classical qualitative approach against risk premia, towards risk premia, and we also have the systematic way of doing it. I guess that previously in the past people thought that you had to be a qualitative manager to be able to do value, for instance, but nowadays we know it's also done through a quantitative approach, etc. And I think this presentation is really interesting to see the longer term picture, etc. But I think there's a lot of things here to discuss that I think are important in moving forward within this space. And I think the first thing for us, which has been an important part in our construction of our portfolio, is to be able to differentiate between styles and factors and risk premia. They aren't necessarily the same thing. They are predictors or potential predictors of risk premia. Then again, we don't really know whether or not that's the case going forward. And I know you discussed illiquidity, for instance. Small caps. We believe in small caps, but we don't think that small cap is the perfect predictor of illiquidity premia. So there is something else going on in that space. And I think that's, in a sense, the focus around factors pretty much highlights the difference between an academic approach and what the approach I think an investor should take. The classical generic academic approach is to find an anomaly, more or less backtest an anomaly, see something that works historically, and then try to motivate or understand the underlying dynamics and drivers of the strategy. I'm an engineer. I like that approach, but for me, it's a bit of a reverse engineering situation. And I think that if you're an investment manager, you have to focus on the underlying risk and dynamics and the drivers of the strategy and target your exposure towards that. Then again, since we don't know the drivers of the strategies, as Toby said, that's almost impossible. But I do think that's the approach one has to take going forward. And on macroeconomic drivers, I do agree with Toby that I mean it's impossible to find real clear correlations with respect to macroeconomics in a multi-style portfolio, though I think there are pretty clear dependencies with respect to macroeconomic shifts in some of the strategies. Then again, it shifts through time, which also highlights the fact, well, have you gotten paid for macroeconomics through time, but through a non-linear way, or has it shifted through time? One has to answer these questions in order to gain a greater confidence in the strategies going forward. Take value, for instance. Some believe value is linked to distressed companies. I think that one can prove that value isn't all about distressed companies. There's some other systematic risk within value. May it be inflation, because through time it has shown great correlation with respect to inflation, and I think that you can recreate a lot of the value premium with an inflation exposure. But that also shifts through time. But what happens if inflation drives value, but going forward, price to book doesn't really end up being an inflation exposure? Then you will have a big problem. And I definitely agree on the style timing part. I mean, it's a zero-sum game. It won't be possible for everyone to time styles at the same time. But you would have to understand, if it was possible from a theoretical standpoint, what would be the tools that you would use? You would have superior access to information. I guess AQR has that. You can have a superior calculation ability or an ability to implement strategies in a better way. But I mean, just being strategically diversified and understanding what diversification actually means is much more valuable than to be able to time the strategies themselves. And as Kerstin said, I think it's dangerous just to depend on diversification. We have seen a lot of providers just augmenting noise. 20, 30 strategies with all of them having Sharpe ratios of 0.2, 0.1, 0.3. Augmenting noise leads to a Sharpe ratio of 3. So a rule of thumb, when you see that, just divide it by 2 or 3 or something like that, and you will end up with what you will expect ex ante.
So to conclude, it's not very easy to harvest this, you can say, alpha risk premium. And that's what you're trying to do, Fredrik, and trying to find out how we could do it better. But you say, Toby, is a little bit like, of course, if you have a very long-term period, but usually we work in a shorter periods, and the problem is maybe to get enough confidence that this strategy will give stable returns over time. And I don't know. So far, we are still developing our strategies. We are still not convinced, but working very hard with it. Yeah. So.
Okay. Thank you very much. Would you like to comment?
Oh, sure. So first of all, it sounds like we agree quite a bit. One thing I'll say is I think a couple of points that were highlighted that I absolutely agree with is if you think about, so first of all, a Sharpe ratio of 3, does anyone know what a Sharpe ratio of 3 looks like, by the way? Bernie Madoff's portfolio, which never lost money, had a Sharpe ratio of 2.9. Until it didn't, of course. But so I think to your point, if someone presents you with a Sharpe ratio of 3, you're lucky if it's just noise that they've levered up. I don't believe that we see those. What the best I can show you, even gross of costs and fees with all these styles and all these asset classes, is maybe a Sharpe ratio of about 1.2. You take off fees from that and trading costs, which we didn't have time to talk about yet, but we could talk about now. Cut that in half. So when you talk about a diversified portfolio of these styles in all these asset classes, maybe you're talking 0.6 to 0.8 Sharpe ratio. So when we talk about stability in the short term, you're not going to get it, right? Even at a 0.8 Sharpe ratio, that means it does better than average 2 out of 3 years. That's about the best you can hope for. Now, for a long-term trading strategy, that works great. So I'll take the flip side of that, which is, does anybody know what Warren Buffett's Sharpe ratio is historically, right? The wealthiest investor in the world, he's at 0.6, okay? Now, 0.6 for 50 years gets you $90 billion, but we don't always have the luxury of 50 years. And that's, I think, the trade-off that it sounds like you're finding as well, which is diversification as a concept is great long-term. Short-term, it's going to leave you short very often, right? And so that's the struggle that, as an academic, I thankfully don't have to deal with all the time. But I think it's a very real struggle. So I think of these as long-term risk premium. But yeah, they're not going to solve the short-term problem for sure. So let me stop there and see if there's. So thank you.
And you also mentioned the transaction cost, and we did pointed on it, and that's, of course, you can say the turnover is very high in these strategies, and of course you have to be aware of transaction costs.
That's right.
Yeah.
And also on top of that, you know, rather than just equities, when you start dealing with fixed income, commodities, and currencies, now you've got to worry about leverage, monitoring the risks and volatility, and that's a whole nother set of transactions costs you've got to deal with, and risk management. So that's the part my AQR colleagues are very good at. Yeah, you know, and this is just the concept. So.
Okay, we have a bit over 10 minutes, so please, questions, comments, whatever. Yes, Mats.
Very interesting presentation.
Thank you.
For a practical practitioner that wasn't able to go long short, as all your studies showed, it's interesting to know whether the performance was created on the short side, on the long side, where it's avoiding things or actually buying things that creates the returns. And the second is, if you don't like the volatility as a risk measure, if you looked at instead of drawdowns or capital loss as a risk measure, could that still be used, and would it change the conclusion?
So two great questions. First of all, the long and shorts, it turns out, it's about 50-50. So AQR, for instance, we manage $225 billion right now, mostly in these kinds of strategies. About 70% of that is long only. And so the idea is, again, if you're constrained, you just take the long side of that, or you express it as an underweight for the short positions, right? But you're still long only. So I think there's no difference in the long and short positions. That's not too surprising when you can implement all of this with futures contracts, except for individual equities, of course. That's the first thing. The second thing is, your question about other measures of risk is a great one. I only showed you volatility, but actually if you look at skewness and drawdown in particular, you see even bigger benefits here. So volatility definitely goes down, but the key thing is downside volatility and drawdowns, they diminish quite a bit. So, you know, I think the maximum drawdown for each individual factor is on the order, say it's value or momentum or any of these. You can find drawdown periods of, you know, 30% or more over a small time span. You can cut that down to single digits when you apply a diversified portfolio. So I think that's kind of nice as well.
Thank you.
Okay, I saw a hand.
With the same
Yeah. Anyone? Paolo?
I was wondering whether you could comment a little bit on the trend into indexing versus active investing, and how do you see this type of strategy fitting? And you know, where do you think we're getting into too much indexing? There is a lot of debate in the practitioner among that and so forth.
So a couple of questions embedded in there. Let me talk about it first in the context of these strategies. There's a big debate as to whether and I think, you know, we had some of this here, which is, do you call these things risks or styles, or what piece of it is risk or style? That's being debated in academic literature. It's certainly being debated in practice. I don't have a great answer for that. So some, you know, at AQR, I think we would call these things more passive in nature, but they require a hell of a lot of trading. So I don't know how you call it passive when we certainly employ a lot of people to manage these things. That doesn't seem very passive. On the other hand, I think the concept is somewhat passive. So I think there's some debate. The trend towards indexing, we haven't seen it affect these strategies per se. There's even debate as to whether it's affecting markets at all, which is, I think, the more general question. I mean, I think although there's been a big trend in indexing, I still think it's the case that the amount of indexed assets is still only on the order of 25, 30%. It's not, you know, I think if we get to a point where it's 80% of investors are indexing, maybe we'll see some effects, but we're very far from that. As an academic, I think it's a good thing. In fact, as an AQR employee, I think it is too. I think it's better for investors, but I don't think we've seen, you know, huge effects. But I'm curious to hear what you guys think as well.
I don't think that effect would be enormous. And I think that as long as this is linked to a strong bias, a behavior that doesn't really disappear if someone notices that bias. And if it's a risk-based story, I do think there is a supply and demand of risk, which is clear. I mean, just look at low volatility and the crash. Everyone started to flee volatility, and we saw a lot of index funds doing low volatility, etc. And I do think that's a great example of the supply and demand of these risks going on, even though we have ETFs, etc., starting to invest in these things.
Okay, we have time for one last question. Yes, please.
Yes, I was just wondering if you could tell a bit about the data that you've been using. How is it unique?
Yes, so this data we came about, a couple of colleagues at AQR have been collecting this for many years. In fact, where it started was we run also a strategy I didn't talk about was sort of like a managed future strategy. It's basically a momentum strategy, but through time. They found all this commodities data going back to the 1800s and said, well, let's look at this in a century's worth of timing. And then it turned out that, or in terms of managed futures type strategies, it turned out then that we found this other data related to it, that we could take this, apply it all the way back in fixed income markets as well, and in equity index futures. And so, one of the advantages of working at AQR is I have an army of very smart undergraduates and graduates who can build this stuff up. We're actually going to make the data publicly available. So if people want to play around with it, it'll be on the website, my academic website, as well as AQR's website, where we're hoping to have like the FAMA French portfolios, but with another 50 years and in other asset classes for people to play with. So it took about 5 or 6 years to sort of put together, and we purchased a number of data items, but then cleaned it up, and that's where we have it right now. So. And eventually we'll also add trading costs and other an estimate of them anyway. That's the one thing we get to ignore in academia, but I think is critically important. So.
Okay, yes.
Is there a reason why academics still don't include trading costs?
Yeah, we don't know anything about it.
But you do,
yeah.
there are plenty of research on it. So.
Yeah, but not, okay, so I'm going to get myself into trouble here. Not very informed research, I would argue. The problem, and it's not the academic's fault. The problem is what we have to work with is we have theory models, which are very interesting. And then we have data, which consists of trade and quote data, which is an aggregate of everybody's trades, which is not a very good way to measure, the trading costs that anybody here in this room would face. Because what you're talking about is a mixture of insiders, liquidity demanders, as well as patient traders. I mean, I'm sure the way you guys trade is totally different than the way an individual investor would trade, or certainly an informed trader. So we haven't had access to that data. Now I'm gonna sell my own book here in the following. It's not an actual book, but in my research. AQR, in addition to letting me use this data, they've been trading globally for 19 years. They're letting me use every trade they've ever made to actually, over this 19-year period, to actually back out what a trading cost function looks like for a large institution. So it ends up being 1.7 trillion data points, which is fun to work with, by the way. But what we're trying to do is now start to get a picture of that. So I'm hoping to make, at least, I can't make those individual trades publicly available because there's fiduciary responsibilities. What I can make available is the functions we're creating based off of them that people can use. So I'm hoping this will change. And by the way, everybody in this room can help. If you're willing to give out your data on trading costs and trades, we will learn a lot more about this. But that's the main reason. We just don't have access to that. It's one of the things that I've learned probably the most with my work at AQR is about how to implement. So very important.
You maybe can mention a little bit about our experience in trading costs.
Yeah, I mean, trading costs for us has two different parts of it. If you go to an external party, obviously you have all of these fees, etc., going on to you. But and I read parts of your paper on trading costs, and you estimate them being much lower than previously accounted for in academics, and that's also what we've seen. And I mean, you should construct your strategy with the transaction costs in mind, trying to minimize them. Really, that's an enemy. I wouldn't say that they are to a great extent hampering the results too much. They're not a big portion of these styles, but as soon as you go into more frequent trading, if you do say a mean reversion strategy, etc., it definitely becomes a big part of the result.
Yes, absolutely. I mean, I think what we'll find if that data gets brought to academia, I think what you'll find is there will be plenty of strategies that survive those trading costs easily, and many that won't. And particularly the high turnover, mean reversion type strategies, I think don't. That's been our experience as well.
But we can also say from an overall portfolio perspective, we would never see this as a huge diversifier in our portfolio. We can never get the part of the portfolio that makes sense. So still, we have to trust on fixed income and currency. We have the luck to be in a small currency that actually moves a little bit during the business cycle. So we don't know what's happening next time, but the old time when we have had the crisis, the Swedish currency has been extremely weak. So you can say from history, we can use currency exposure as a diversifier, working quite well if we come into a crisis.
Oh, that's interesting.
Yeah.
No, and there's a point well taken, which is these long short strategies and these styles are not meant to replace general equity and fixed income exposure. That you have to start with. I just figured everyone's figured that out already.
Yeah,
right?
yeah. But I have to mention
yes,
it anyway.
exactly. You're totally right. Absolutely right.
Okay, thank you very much. We all have work to go to, and we've run out of time, and you all have meetings. Thank you very much for coming this morning, and in particular, Tony, Kerstin, Fredrik, thank you very much for your contribution.